Hey everybody, in this video we're going to be taking a look at the Chapter 9 homework problems. And in Chapter 9, we don't have any of the practice with feedback, interactive exercises, with the red X's that go away. So we just kind of have these work problems and discussion problems, etc. So with that said, let's dive in and take a look at these work problems and discussion problems. Okay, so I'm going to give myself a little space here. Insert a text box. And the first question asks us, what is the difference between direct and indirect expenses related to departmental accounting? And when we're talking about indirect and direct, it's sort of similar to like the concept of overhead expenses, but a little bit different in terms of we're specifically talking about departments at this point, essentially. So direct expenses are those that can be traced directly to a department because they are incurred only for the benefit of that department, whereas indirect expenses are incurred for the benefit of more than one department. And like we talked about in class, that could be something, like a lot of that is like administrative costs. So if you have an IT department or a accounting department, for example, that's doing the work for a whole company, you're not going to have a specific IT department or HR department or accounting department that works for individual departments. You're going to have one for the overall company. And so those would be more indirect in nature. And then if you had, expenses, you might have a supervisor or something that's for that specific department. So that supervisor might supervise multiple employees and maybe do different tasks, but that all of the efforts from that supervisor go towards that specific department. So that would be more of a direct expense. Okay, question number 2 asks us, what are the 2 main goals in managerial accounting for reporting on and analyzing departments? And the 2 main goals for departmental accounting include 1, measuring efficiency and effectiveness of each department, and 2, evaluating performance of each department manager. So again, to that idea of having a department manager or supervisor, we're going to want to be able to look at those departments and see, both from a manager perspective and just overall department perspective, how is the department performing? How is it performing against other departments? So on and so forth. So, okay, let's go down to question number 3. What is the difference between operating and service departments? And operating departments produce products or services, or sell products or services. Service departments support the operating departments, or service those departments, if you want to kind of think of it that way. Examples of service departments include things like we just talked about: HR, janitorial, IT, accounting, etc. Okay, let's get a little space here. Is it possible to evaluate a cost center's profitability? This one's a little interesting. Profitability for a cost center is not typically measured because, like we talked about in class, and I'll write this in here, normally a cost center is evaluated by its effectiveness and efficiency, particularly in regard to the costs incurred by the cost center. Because they're not like we said above, they're not necessarily selling products or services, so they're not directly generating revenue. But there is, I say, however, it is possible to evaluate a cost center's profitability, but only if that cost center charges other departments for its services. So that's really kind of outside of the norm of what we've been talking about in this chapter. But that is a possibility of possibly implementing a method to where there can sort of be a profit. It's kind of like the profit is generated by the operating departments, right, that are selling services or products. And then if we want to sort of evaluate this in terms of, or think about it in terms of the cost center, then like an IT, HR, janitorial, whatever, as kind of a almost thinking of it like a third party service provider. They are all internally and within one company. But if you want to sort of think of it like, if that operating department, that sales department was a standalone business and they had to contract out to get janitorial services or IT services or whatever, then you can kind of, in a way, you could have the servicing department. Not necessarily that the manager of the operating department is going to cut a check to the service department per se, but you could think of some different ways to sort of think of them all as independent businesses, almost, if you want to think of it like that. And you could analyze how what the if the service department does sort of charge a fee, quote unquote fee, to the other departments, you could set it up in a way to do sort of an analysis like that. But typically that's really kind of outside the norm, and the typical thing is just to evaluate the cost center on its efficiency from a cost perspective. Okay, how is the department's contribution to overhead measured? Where are we at? Okay, so sales less the department's direct expenses. So remember, and it would say direct expenses always include cost of goods sold plus other direct costs. So remember, we talked about this in class of how much is each individual department generating in net income, in terms of the direct costs associated with them, and then how much is left over to pool from those different departments, essentially, if you want to think of it that way, to cover the overhead costs that are necessary to run the business. Okay, our next question says, why should managers be involved closely in preparing their responsibility accounting budgets? And I think this one is pretty logical and straightforward, because if the manager is going to be held accountable to that budget, then the manager should have some responsibility in its, or maybe not responsibility, but some, let's say, some input in the budget overall. The manager is more likely to accept and control costs if they had a hand in preparing the budget in the first place. Compare that to just being handed some sort of budget that you had no say in. And, as a manager, if you're a good manager, you're going to, develop a good budget and you're going to be the one who has the most information about your department and probably can help develop the most realistic budget. And if you just get handed some budget that might not be realistic or is missing some nuance or something, that can be really annoying from a managerial perspective and can lead to some conflict in terms of adhering to the budget and respecting the budget and all that kind of stuff. So it's a best practice to involve people and not just force them to adhere to some budget that is developed without their input. Okay, last question. What are controllable costs? Controllable costs are the costs that are, it's kind of controllable by a given department manager. And they vary depending on the department and manager. So something like property taxes for a given, if a given department is using a specific location or a building, and there might be some property taxes associated with that building. And while that might be a direct cost, potentially, or at least a cost that's closely related to that specific department that the manager oversees, they might not have any option to, that might just be driven by the government essentially telling you how much property taxes you have to pay. And so that's really outside of the ability of a manager to control. Things that are much more controllable would be something like salaries and benefits and headcount and how, hiring individuals and making decisions to promote certain people and, maybe developing whether or not your department's getting certain bonuses or something like that. Something that you could actually have a direct hand in controlling versus things that are outside of your control. So, okay, that's our first tab there. Let's go over to the QS tab. So this is a quick study. And let's take a quick look here at our quick study. Okay, so this problem we've got, what do we got? 1, 2, 3, 4. Gosh, there's a lot on these, so I'm going to get rid of those. I'm going to move this down. And let's give ourselves a little more space again. Sometimes when things are too bunched up for me personally, it just makes me feel a little overwhelmed. Okay, so now we've got some space here, and I just want to focus on this first problem. And this problem says, for each of the following types of indirect expenses and service department expenses, identify one allocation base that could be used to distribute it to the departments indicated. So computer service expenses of production scheduling for operating departments. So this would be kind of like an IT department type of thing. And there could be numerous answers to this question. This is sort of a use your judgment type of deal. You could say, let's think. So what would you base this on? It could be based on production hours. If one department has more production hours, it's probably going to be likely that there's more IT support going to that in regard to the production of the scheduling. You could have number of schedules. That's a pretty easy one, right? That kind of maybe goes hand in hand. Computer processing time, if you could somehow figure out a way to analyze, what the department has been working on, or which, if you could kind of track the work of the IT department and tie that back into specific departments, so on and so forth. So there's some examples. General office department expenses. Let's see. Number of employees or proportion of sales would probably be two good bases to use. So if we have, if you're trying to find something that is allocable, having sales, you can kind of tell how that allocates, or employees is a pretty direct one. You could also do, I'll say, or personnel, office personnel. Let me see how I spell that. Office personnel time studies. So you could go out and do some level of study or You could request a survey or something to try and get just an overall, maybe if you have 2 departments, you could send a survey out to all the office employees and say, how much time do you spend working to support Department 1 versus Department 2, right? And then the employees in the office could just respond, and you can get a general idea. It's an estimate. All these things are basically estimates, but that's one way to do it as well. Yeah. So, okay, let's look at maintenance department expenses. We've talked about operating machine hours in the past, and that might be a good one if you're using more machine time. You're probably going to have more maintenance allocated to you, number of machines. So if a certain department has more machines, they're probably going to use up more of the maintenance departments. They're going to need more help from the maintenance department, etc. Yeah. Machines. I mean, you could even say like, yeah, let's just leave it at that. I think those are 2 good. Those are 2 good examples there. And then electric utility expenses. We could base, let's say, square footage of the department. If a department is bigger, it probably uses up more electricity. Maybe number of lights or wattage used, things of that nature. So somehow being able to see and look, if Department 1 has a certain location and Department 2 has a different building, you can kind of analyze those and see how much energy is being used by each department or building, and therefore each department, and kind of allocate that way. So again, it's up to us. This is the managerial part of making decisions and doing analysis, and there's no definitive right answer, but these are all reasonable and answers that would probably make a lot of sense. Okay, here we've got some terms to go through. And we've got, the first one says cost center. And so remember that our cost center is going to be something that doesn't generate revenues, right? So we incur costs without directly generating revenues. In an investment center, remember that's kind of a whole division, if you will. And so it's got its whole own area, it's got its own balance sheet, its own revenues and costs. It's kind of almost a standalone business, but under one umbrella. And so that will be our investment center. The departmental accounting system provides information to evaluate the department's performance. Operating department, so we've already kind of talked about this one, and as we said before, we engage directly in manufacturing or making sales. So this is a department that's more either producing the products, customer facing, making sales. It has its own income statement. You can calculate net income of each operating department generally. I guess that would be more of our profit center. The operating department can be in that sales role, but also it could be in directly in manufacturing versus support. So one distinction there. But then the profit center incurs costs and generate revenues there. So that's C. The responsibility accounting system. So again, this is about analyzing holding departments accountable. And so our responsibility accounting system provides information used to evaluate the performance of that individual department manager. And finally, our service department, and we don't directly manufacture products, but we contribute to the overall profitability by assisting the operating departments with producing manufactured products or making sales directly to customers. Again, like HR or IT, stuff like that, accounting, etc. Okay, let's go on to number 3. Give myself some space. Okay, use the information on the following table to compute each department's contribution to overhead, both in dollars and percent. Which one contributes a largest dollar amount and percentage? Okay, so pretty easy math. These ones aren't too challenging. Remember, we're taking our gross profit Let me see here. Is this all we're doing? Yeah, we're basically just, okay. This is super easy. Just finish the formula basically, right? So take gross profit. So you have sales minus cost of goods sold, and then minus the direct expenses that pertain to that specific department to get the total contribution to overhead. Basically, kind of like how much net income is the department, producing before its indirect expenses of the whole company, essentially. And then if we want to get our contribution percentage, let me see, where are we taking this from? 41. So our contribution to overhead, we divide that by sales. Yeah. So divide it by total sales. Oh, it says it up here as a percent of sales. And so we can see that Department B provides the highest dollar amount of contribution overhead, but Department A on a percentage basis provides the most. So yeah, just kind of different ways to look at things. And that's not saying that one department's better than the other necessarily, but it just gives you some information about how much indirect and direct expenses certain departments have. And, hopefully they complement each other and do different things. And as long as they're producing some contribution overhead, remember that's kind of what you want to see. And only at the point at where you start seeing a negative contribution overhead, that a department almost becomes like a burden to the rest of the company, that's where you're going to run into issues and have problems there. So we'll write this in. So Department B has the highest dollar amount of contribution to overhead, but Department A has the top percent. Let's just do it that way. Fits in there. Oh, spelled that wrong. Okay. Number 4, compute return on assets for each of these best buy decisions. Each is an investment center. And we're going to comment on the relative performance of each investment center. So very, let's put our stuff in. Real simple calculation, just taking, messed up my little formula there. Got my, I like to keep the formatting on the bottom. Got rid of it. So let's just move those down. Now we keep, oh geez. Okay. So commenting on the relative performance of each investment center. This is the highest, you can see how they go down, and it takes more assets, but the cameras and camcorders produce more net income. And so I don't know, really, there's not much else to say on this, I guess. It is what it is. It's really just looking and seeing what return on, and this is return on assets. We talk about return on investment a lot of the time. But return on assets is a very similar metric. And yeah, top, middle, bottom. I'm not sure what else we want to say. They're all productive. They're all positive. So they're all performing well. You need less assets, here, but these assets are all, in general, the more assets are kind of invested into these different divisions, the more net income they're making. So I don't know if that says anything about whether you were to invest more into these areas, they would increase in terms of return on assets. But, from a management perspective, that's just something to kind of look at. Okay, let's go on to our next tab here, our exercises tab. And we'll work. Okay, in the exercises tab here, we have, following is a partially completed lower section of a departmental allocation spreadsheet. For this bookstore, it reports the total amount of direct and indirect expenses. Complete the spreadsheet by allocating the expense of the 2 service departments to the 3 operating departments. Okay, so apparently it's similar to one of the in-class problems from our folder. And yeah, let's take a look. So remember really what we're trying to do. So these are our two service departments. And so in essence, what we want to see is we want to allocate these totals out to the other departments, right? Books, magazines, and newspapers. And so it tells us down here as well. So this is some more information that we need. So advertising and purchasing departments, they're allocated on the basis of dollar sales and purchase orders, respectively. So when it says respectively, that means the first one, advertising, is allocated based on the first one, dollar sales, and purchasing is allocated based on purchase orders. And so, okay, so we've got total sales of 800,000, total purchase orders of 1,000. And we can kind of, if we want to add a little bit more, I'm trying to think of the best way to do this. So essentially, if we wanted to look and say the books, really what we want to do is we want to divide by the total, right, for the individual amount here. So when we're looking at books, it's 40%. And something I'm going to do here is I'm going to click into this, click F4 to get the two dollar signs so that it makes the denominator of 1,000 stay the same. So when I drag this down, it doesn't move the formula. You can see that it just stays the same. And we get, does that make sense? You know, that's not really the best way to present that, I guess, because so we're allocating the purchasing department expenses on these POs, but we're allocating, you know, let's do sales first. You got to kind of look at these and think, how does the best way to present these? So here's our totals. And again, if we were to add these all up, it should equal 100%. We're just breaking this out. But then I'm going to go into my formula bar and hit Control X to copy that or cut that formula. And then I'm going to paste them more horizontally as opposed to vertically, because our departments are more horizontally aligned there. And then let's do a similar thing, and let's just do this more manually, make it easy. So newspapers. Okay. And then if we were to just add those up across, we just to prove they're all 100%. Okay. Okay, so now we have the proportions, of the breakdown here. So if we want to allocate our advertising expenses and our purchasing expenses, the kind of, let's do this. So expense account balance. So this is really just saying, I guess we could put this in here as well if we wanted to. Advertising department, sales, you know, we just make it seeing how to kind of trying to figure out what is the value of having those. I'm going to just leave those blank. But one thing I did want to note was that we're going to start with 653 total account balance here. So you can see that's the sum of all these. And what we're going to want to do is to take these two departments essentially and put them into our operating departments. So our total is going to be the same. That's what we're shooting for. And we can do this with like a formula too, just to make sure that works. So 653. And then we're going to do a formula here as well. And then we're going to do, this is going to come down like that. And let's do a summation. So we're going to just sum up. So when we sum these, they're gone. So advertising and purchasing have been taken, out of, there's nothing left in those individually, and we're going to spread them instead across the other parts. So for advertising, again, we're doing, which one is the advertising? That's based on sales, right? Yeah. So we're going to take that 23,000 times the 50%, 55% of sales. We're going to need to do a negative because we're making that positive essentially. And so what we're saying again is 55% of the total sales are done in the books department, right? And that's just that's the total percentage. And then we take that percentage and multiply it by the total advertising to allocate a piece of that to the books department. Let's use we're going to go in here. I want to keep this formula the same, but I'm going to drag this across so it drags across and gets the different proportions. So I'm going to again hit F4 to put my little dollar signs in. And then I just drag that across, and you can see that it multiplies out that 23,000 each time. And then we can do something similar down here. Heck, I'll just drag this down, but then move this cell and then drag that across. I think that should work. And so you can see all three of those, that adds up to 30,000. So we're just separating, allocating this out into the individual departments, right? Okay, and then this is our formula. And so our new departmental total for expenses then become 450, 97, and 105. But as you can see, if we just sum these all up, just like we did here, it started at 653, it ends at 653. So all we've done, we haven't changed the amounts at all. We've just zeroed out these two service departments and allocated those expenses out to the specific operating departments. Okay. Cool. I think we got everything there. Oh, it has a check figure too. So, yep, that's good. We got the same check figure answer. So, right on. That's important. Okay, so let's look at number 2. Okay, what are we on? Exercise 2 says Expert Garage pays $128,000 rent for each year for its 2-story building. The space is occupied by 5 departments. Here you can see. The company allocates 65% of total rent expense to the first floor and 35% to the second, and then allocates rent to each of the floor, occupying that based on the amount of space occupied. Okay, so we need to allocate just all this stuff out, right? So let's go here and say total rent. So again, it told us 128,000. Okay, and then it tells us, so the first and second floor, they're not based on the, let me make sure, 65. Okay, yeah, so we have a first floor and a second floor, right, space. So a portion of this 128,000 just gets allocated out kind of, or it gets separated first and then it gets allocated. So there's really like 2 levels of allocation going on here, right? So first thing we need to do is first floor and then second floor. And let's go 0.65 and 0.35. A little space in between here, but so the first thing we're going to do is just allocate. Oh, why is that looking funny? Oh, I got to align it that way. The first thing we do is just allocate the totals out from first and second floor into these amounts here. And then we're going to split these amounts. Again, we're doing kind of 2 levels of allocation. So let's say first floor departments, and we have paint and engine. And that just tells us, here's the 2 first floor apartments. And let's say square footage. And what did we have? Can we link up to these? Yeah, that's good. It's always better if you can link. That is what I find makes Excel work like it's supposed to. Okay, so here's our totals. And let's say percent. So 31% to paint. Again, I'm going to do my little $signs so it stays with the denominator. Let's make these percentages. So 31 goes to paint and 69% goes to engine. Let's make it a header here. And then we'll say rent allocation, maybe a little more space there. Let's just do it like that. And then again, we're doing first floor, so the total is 83,000. I'm going to hit F4 to lock that cell because we want to use it again. But 31% of that total, do a format painter here. 31% of the 83,200 is 26,000, and then 69% is 83,200. So then we end up right back with the total. So that's important because when you allocate something, the total should still be the same. It's just allocated to specific, departments. Okay, so that's great. Let's give ourselves some more room. I'm going to copy at least the top one here, the top part of that formula, because it's going to be very similar. And in the second department, we have the windows, the electrical, and the accessory. Here's our breakdown of the square footage. Let's add a footer here. We add everything together. Let's fix our formula because we just copied that and it's had the $sign, so it's still linked to the total there, but we want oh, they're exactly the same total, so that's interesting. Okay, let's format paint that. But we have 3 departments here, so an extra little space, but that's fine. Nothing different there. And let's fix our formula again. So now we're breaking up 44,800, not 83,200. Okay, and so now we've got amounts. If each of these departments had their own income statement, we would take, we'd have maybe like a rent expense line item, and each of the departments then would get these different amounts allocated out to it. So cool. Sometimes you just got to think. These are kind of thinking problems that requires a little more subjective analysis as opposed to, just bookkeeping, debits and credits, always the same type of thing. Okay, so what does this one say? We're managing an auto dealership service department. We got an income statement. Analyze the items on the income statement and identify those that definitely should be included on a performance report. And then list items that should be excluded. Oh, and then list ones that are kind of in the middle. Okay, so let's just do it like this. So items to definitely include. And that would be things like sales, COGS, supplies, hourly wages, and these are all items that are under the department manager's control. And let's say items to definitely exclude would be things like building, depreciation, income taxes allocated. Let's see what else. Interest on long-term debt, department managers' salary. Again, salaries would be under the control of manager generally, but not his or her own The manager's salary specifically wouldn't be, because that would be determined by their supervisor. The employees may be under, maybe not, but maybe. And then we're going to say we are assuming that the manager does not control these items, but let's have a caveat that utilities might be partially controllable. Make sure you're turning the lights out at night, and then that kind of thing, right? Some of those are supervisory kind of actions that can be taken. Items that could be included or excluded. I think I'll just do like we did above. Let's see, payroll taxes. And what else? As mentioned, because like we said, to some degree, the payroll taxes are sort of related to if the manager is responsible for the salary of the employees. I don't know. Those still could be excluded though too, because they are kind of a byproduct. But if the pay is lower or more controlled, maybe the taxes are lower. As mentioned above, utilities could be included. I'm just gonna, let's just take that out of there and put it down here, because if it's unclear, I guess we should be putting that in number 3. These ones are definitive. Yeah, one thing that's noted here, and it talks about in the answer key that I think is a good point, that both of these items are potentially minor and would not be included in and may not be worthwhile to include on a responsibility performance report to assess the manager on. Things you really want to assess are all up here, sales, cost of goods sold, supplies, hourly wages. Kind of like we're saying, that the hourly wages derives the payroll taxes, so that is sort of included. But again, those are a function of government requirements, etc. So it's not like the manager, they can control the hours that the employee works, which in turn affects payroll taxes, but that's kind of a byproduct. So yeah, cool. Good problem. I think that's interesting to think about. Okay, number 4. Gets more space again. So Z-Mart, a retailer of consumer goods, provides the following information on 2 of its departments, each considered an investment center. Okay, cool. So we've got sales, and we've got electronics and sporting goods are the 2 departments. Okay, so what do we need to do? We need to compute return on investment using return on investment, which department is the most efficient to generate returns. And then, okay, let's just start with that. So let's do ROI. I'm just going to extend this table. I think that's worthwhile. Let's make that a little easier there. Okay, let's just say ROI. And we're going to take net income divided by average invested assets. Let's turn it into a percentage. So what do we get? 20% and 16%. So he gets rid of the little border on the bottom. And I know I'm being super picky, but here I can do this. That looks better. Okay. Okay. So that's number 1. And the electronics is more efficient. We can see here it's got a higher return on investment. Assume a target income level of 12% of average invested assets. Compute residual income for each department. Which department generated the most residual income? And residual income, we talked, yeah, it's in the text and in the lecture video, etc. And so when we are talking about residual income, then we're going to want to take our target ROI, right? So I think let me see, what would our easiest way? A target return. So if we have a target ROI of, remember it says down here 12%. Let's try to kind of just back into what we would need then. So a target income at 12%. Let's think about this. So let me do a little thinking here. So we have the same average invested assets. We want we're basically solving for X, like a little bit of an algebra problem here. Let's not have it. This is kind of my notes off to the side. So solve for X. Why is that? What's going on here? There we go. Okay, we're solving for X. So this is our average invested assets, and then our result would be 0.12. And for me, sometimes just thinking this through. So we would need X divided, how does that work? Let's think here. So not sales, but net income. So net income divided by, so we need X divided by 375 equals 12%. I need to write this on a piece of paper. I get my brain to work on it. So, but if we take, okay, I think that makes sense. So we're saying, and then let's work backwards on this. So basically we're saying if we had $450,000 of net income divided by the average invested assets, that would get us 12%. Yeah, okay, that makes sense. So to figure that out, you just take the average invested assets times the target ROI, as opposed to the first calculation directly of ROI is net income divided by average invested assets. So not rocket science, but it does kind of like take some thinking to get through that. So we can calculate that again. Let's just do it like this. So if we had 0.12 times the average invested assets, and then we can do the same, equals 0.12. That's our target ROI times average invested assets. Whoa. Get that in a same format there. So 600,000 is what we'd want for our net income, basically, if we're going to have a 12% ROI on the assets with the assets that we have invested. So then we would say that the who generated the most residual income. So then the residual income is just saying how much. Let's extend this one more time. Our net income minus, so everything above, if that was our target ROI, we say, we're doing even better than we thought. And we have residual income, that's this amount for each department. And electronics is, producing more. So that's cool. And what was the question? Assume the electronics is, okay, so that's that. And assume the electronics department is presented with a new investment opportunity that will yield a 15% return on assets should the investment opportunity be accepted. Yeah, I mean, that sounds great, right? We're shooting for a 15%, ROI. We're getting 12%. So if we're able to get a higher than expected ROI based on that new opportunity, then it seems like it would be a valuable opportunity. So we'll say invest in additional electronics to make more than targeted net income. I'm just going to highlight that in red so you can see it's our answer there. So, I mean, we could just do this for the heck of it, just to put a direct answer in. We'll say electronics is the most efficient at using its assets to generate returns. But that doesn't mean we should get rid of sporting goods. It's just saying that it is the more efficient, you higher return on investment, etc. And so, yeah, but sporting goods is still contributing, you know, making net income, all that kind of stuff. So sometimes there's value to having a varied, you know, you get more customers in the store, or more customers, buying from your company. Maybe if they have some crossover between these two things or something. So there's value beyond just the direct financial incentive sometimes. Okay, let's look at the last one here. This is question 5. Ocean Seafood Company purchases lobsters, processes them, sells the lobsters for 20 pounds, the flakes for 15 per pound. On average, 100 pounds of lobster processed, 57 pounds of tails, 24 pounds of flakes, 19 pounds of waste. Assume that the company purchased 3,000 pounds of lobster for $6 per pound and processes the lobster with an additional labor cost. No materials or costs are assigned to the waste. What is the cost to process tails and flakes? You are going to use the sales values, calculate the answer by following the next steps provided. So lots of words, and yeah, let's take a look. Okay, so step 1, calculate the total cost for 3,000 pounds of lobster, including purchase cost and additional labor. So let's do cost of lobster, and it's 3,000 pounds. And it tells us above that is $6 per pound. So we'll say times $6 per pound. So 3,000 times 6, so 18,000. Okay, and then let's say the labor to process. It tells us up here additional cost. Okay, so 1,800, just 1,800 flat. That's just, you know, just tells us what the amount for labor was. And so the total cost, just add those two together, 19,800. Okay, and then let's calculate the pounds of tails and flakes that result from processing. Tails and flakes are your products, so pounds of tails, and this is going to be 3,000 pounds of the lobster times, and it says on average 100 pounds of lobster processed into 57 pounds of tails, 24 pounds of flakes, and 19 pounds of waste. So so it's 100 pounds, so 57 per 100 is the same thing as 0.57 or 57%. And then let's just, since we already have this kind of set up, pounds of flakes. And then the rest of it's waste. It's not 57% here, it's 24%. Yeah. So then we can say equals 3,000 times 0.57 and 0.24 for the flakes. Add those together, and that gives us our total. Let's just say total, what do we want to say? Total processed non-waste pounds. Okay, and then, I mean, just out of curiosity, it doesn't ask us for this directly, but if you can kind of see 57 plus 24 is what, 80, 91% or something, plus 57 plus 24, 81. So there's 19%, 19 out of every 100 pounds, 19 pounds is waste. Basically, we're saying shells and stuff like that. Okay, now let's look at the sale. And so calculate the sales value of the processed lobster. And let's say the value of the tails. In this one, we have 1,710 pounds, right? Times $20 per tail, I think it says. Is that what it says? $20 per pound. So 20. And then we've got 720 pounds of flakes times $15. It tells us 20 and 15. So let's go here times 20, and let's go here times 15. So 45,000 bucks. I'm gonna differentiate between the dollars and the pounds here. Okay, so those are dollars. The percentage of total sales value to each product, and then if we want to see the percentage, $76 and $24, which adds up to 100, right? That's what we're doing there. Okay, almost done. This is a cool problem, very realistic for what you might be doing. Making calculations. Not something you'd see, on a test per se. I don't think is at this level of having to go through, but good to know anyway. Okay, and finally, multiply the total cost for both products times the sales value percentage to get the cost associated to each product. To get the cost per pound, divide the total cost for each product by the pounds processed for each product. Okay, so that's a lot of words. So what we're saying there is the cost of tails, tails, is, again, our total cost was $19,800 times 76%, because that was our sales value. So we're just allocating the cost out based on the sales percentage. And this one's the cost of flakes. Again, that was 24% from above. And then the total equals 19,800 times 76%. Let's not look at this right now. And then let's say 19,800 total again. So we're just dividing this. We're just allocating the cost out based on the sales, basically, right? The sales value. And that's what we did right here, was get the sales value percentage. And then we're going to say, what is the, multiply the total cost. Okay. So here's the total cost. And then we get cost per pound. Okay, so then if we want cost per pound, that's the total cost divided by the pounds processed. So the 1710. And this is dollars. This is actual cost per pound. So 880. And then let's do the same. 660, and we don't add those together per se. So, yeah, that was kind of a lot of work. And yeah, we could also do, if we wanted, we could say, what's our value, our revenue per. I guess this would be value of flakes here too. Right, so we could do like, 34,000 in total divided by 1710. So we're selling it for, it doesn't ask us to do this necessarily, but we're selling it for $20 a pound for the tails. Oh, I guess we already we know that, right? Oh yeah, that's what it told us about. Okay, so it already told us that, but if we're just circling back now that we know our costs, then we're making, 20 minus 880, 15. So we're making $11.20 on the sale of the tails and $8.40 on the sale of the flakes per pound. So anyway, yeah, cool problem. This is interesting. This is more of like a real world type thing, but definitely it takes some thinking on these, and you got to kind of like get creative on some of these. So hopefully me walking you through this helps you, because I feel like this problem could be pretty difficult if you didn't kind of have a anchoring point to start from. So, but yeah, kind of a real world problem. Just you got to take a breath, step back, think about what you're trying to do, look at all the factors, and then, it's relatively logical. It's just trying to get yourself, like I said, sort of anchored or in the right thinking mode to solve the problem, basically. So very cool. All right, let's move on to the next tab. Okay, let's look at our last tab here from chapter 9, and this is our PR problem tab. And yeah, let's take a look. Okay, so we have a company that we're looking at here, and we've got 2 departments, video and music. Here's information about those departments. Sales, COGS, we've got direct expenses, and then we've got indirect expenses, indirect costs down below. And here's an allocation. So indirect costs are allocated as follows. Advertising here on the basis of sales, and we can see the sales here. Salaries on the basis of number of employees, and that's here. And office expenses on the basis of square footage there. Okay. So for each department, determine the departmental contribution overhead and departmental net income. And should the video department be eliminated? And explain. Okay, so we've got a check figure here too. So great. So let's make up a little contribution to overhead kind of income statement here. So we have sales, COGS. That's going to give us gross profit. Then we've got direct expenses, and that's what gives us the contribution to overhead. And then we've got indirect costs, and that's all. I'll just link to those because they're all together here. Advertising. I guess I could have linked. I kind of like linking as much as I can, actually. Oops, that's a calculation. And we'll leave that. We'll do our direct expenses as a total. We can just sum up all of the. Actually, let's do that. Let's sum these all up right here. So the total direct expenses are those 2. We're going to need that down below. Okay. So this is our indirect costs. I'm going to indent those just a little bit to kind of separate them out. Total. What do we want to do? So total indirect costs. And this is going to be allocated. And then net income. And yeah, let's do it like that. But let's also create now down below, let's say reference, so information, reference info. And let's have video and music department. This is helpful. This is just going to help us if we create a little breakdown of the allocation factors. It's a lot easier to see it if you have it all in one place and all that. Okay, I'm just going to make some stuff there. So square footage was one of the factors. We'll say square foot percent, number of employees, EPL, how about we say MPL? Yeah, that looks good. And then percent of employees, and then sales and sales percent. And so basically everything's allocated based on a percentage of those different factors. And so we just need to go through and that didn't help. Figure all those percentages out, and then we're going to take those percentages and use them to allocate these indirect costs, essentially, right? Okay, so square footage, video and music. We've got number of employees, video and music. And we've got total sales. That was up here. We could also link it to the other part if we had put it in down here, but that's fine. And let's put total. Let's get another column here, yeah. Okay. Actually, I'm going to do. How about that? That looks good. Okay. Yeah, so we're just going to total all these up. And this is kind of the key to doing any kind of allocation, is just finding the total and then dividing the factor that you're analyzing by. Copy and paste this. I did link. I use that. Need to make sure we're updating the formulas, because it does have those locked cells that with the dollar signs. Cool. Okay, so now we got all the information basically broken out. Here's all of our allocation formulas that we needed. These are our factors that we were analyzing, and we just need to finish putting this puzzle together. So we've got the video department and the music. Actually, let me make this up a little more room. We got video and music here. Okay. Okay, that's better. And then we've got our sales and video and music, cost of goods sold. And then our gross profit is just going to be a calculation of, and actually we could do, let's just make it a negative since it's all together there, just to make it a little more clear. So 57,000 gross profit on video, 98,000 on music. And then our direct expenses, we had those above. We totaled those, so minus 57,000. Uh-oh, our video department is getting wiped out. And then we're going to subtract out the direct expenses. So then we get, we end up with negative contribution overhead. So we've talked about that before. Question number 2 asks us, should the video department be eliminated? That is usually our, it's not like a yes or no question. If it's negative, you'd instantly say, oh, this should axe that department. But that for sure is a red flag and an identifier that potentially this department is just dragging the whole business down, if you want to think of it that way. Okay, and then kind of to further that point, let's go here and say, as far as, so advertising, right, we're allocating that on the basis of sales. So the video department has 58% of sales. Oh, this would be helpful. Let's bring in the totals here. Okay, just formatting all this. So total indirect costs of 45,200, and then as far as advertising, that's based on sales, and so video is going to get 8,700, music's going to get 42. Another way to do that is because this is the total minus, there's only 2 departments, you could just kind of do it that way. So salaries is based on number of employees. So video has 60% of the employees, and office expenses is based on square footage, and video has 63% of that total. So we add those all up and you get 26,900 of indirect expenses allocated to, and then we could just, like I said, take the total minus the portion that's allocated there, and that will give you just, all of anything that's not, there's only 2 departments, so it's either allocated to video or music. So by subtracting one from the other, you're basically doing the same thing as multiplying by the music's allocation percentages. Okay, and then you get totals down here of net income, and we already know we're going to be looking bad, and just sticking with our negatives, I guess, for our expenses. Let's just do it that way. Yeah, we want that to be a sum there. So we already know that video is losing money before we even consider the indirect costs. So this is not going to look great. So that's the whole thing about contribution overhead being zero or negative. Even in this instance, is it's just going to drive it into the ground even further when we allocate the indirect costs to the video department, essentially. So there's the net income by department, and that's number one. And our check figure, $33,500, that is in agreement there, so that is very good. And then let's go take a look here. I'm going to put our answer just in here. So let's say the video department appears to, or let's say has a negative contribution to overhead, thus it should be considered for elimination. How about before making the final decision, management should consider whether any of the direct expenses can be reduced or if revenues can be increased. So maybe that goes without saying, but it's not like something in the business world, if we're looking at this and all of a sudden you see that your certain department seems to be losing money, that you would just immediately say, oh, well, there we go, get rid of it. I mean, this is a complex organization with lots of intertwined pieces, and maybe there's something going on with, as far as direct expenses up here that are leading to be too expensive. Maybe we can reduce the salaries. Maybe we can drop down to just one employee or two employees. Something else to think about too is maybe for some reason maintenance was really high this year. Is this a trend? So I think you really want to look at the performance over a period of time and see whether this is a trend in one direction or the other. Maybe COGS could be brought down, sales could be increased. So this is just a starting point for analysis to guide you as a managerial accountant or CFO or whatever analyst level type of person you are in this business as a manager, and looking at the factors. It's a red flag, like I said, kind of an alarm goes off that says, whoa, something's going wrong here, or something looks funny, and we need to assess this business department and try to understand what's happening and if there's any potential actions that we can take as managers to improve the performance of that department. And if there's not, maybe you try all your things, you're doing this for quite a while, you're looking at trends, it doesn't seem to be a passing trend. It does seem to be that video is on the way out at some point. It's just not sustainable anymore, essentially. So that's kind of the whole idea, though, of calculating out your contribution overhead and then doing those allocations, on some logical basis, basically. All right, these are interesting problems, definitely a little more involved and a little more subjective, I suppose, in certain ways, or kind of thought-provoking, as opposed to just direct numbers, cost accounting type stuff, more managerial accounting focused. And once you get comfortable with it and you sort of understand the factors, I know it can feel a little overwhelming at first, but once you kind of build out models and are doing this type of work, this is work that in the real world you'd be spending a ton of time on. And so it's not typically something that is just, you got to know your debits and credits right off the top of your head. You would be looking at these reports and trying to understand them and trying to dig into the details over weeks and months and talking to people and doing analysis. So in the real world, I think this stuff's kind of fun because you would, like I said, you'd feel more comfortable with it. It wouldn't just be thrown on top of you. You might feel a little out of your depth when you very first start trying to do an analysis, but you eventually kind of get to the point where you understand your analysis and you're kind of like a detective at that point almost.
and then you maybe come up with some good ideas. You try to do some new initiatives, you try to make changes to make it profitable, and then you get to kind of sit back and see whether your efforts are working. And, that's pretty cool. So anyway, all right, well, thanks everybody. Hopefully this was helpful for you all, and I will see you all soon. Have a great day.